our viewers today are in a real treat. First, it was Madhusudan Kela explaining the market strategies. Then we had Prashant Jain, legendary investor. And now we've got Neelkanth Mishra to talk about markets, economy, numbers, and the real inside story. Good morning, sir. So nice to have you back. You are smiling early in the morning. This budget perhaps has influenced, this budget has made sure that you don't have to work too much. It was very clear and evident in terms of what it wants to project.
Exactly. And it was entirely as expected. The only surprise was that they found that room for that 1 lakh crore of tax cuts. But otherwise, the numbers were almost exactly as people expected.
Cheers for the budget or 3 cheers for the budget? Or just cheers?
Cheers is because, I think we overemphasize, and you and I have been discussing this for 15 years. I think the role of the budget in deciding the future for the economy and the markets is actually been shrinking over the years. And I would rather, so the big change now is the start of the trade wars and the impact and the uncertainty it creates is actually quite significant.
Let's talk about the numbers here. The budget estimates, while they are clear in terms of where the fiscal deficit is moving, conservative and effective, what about the revenue assumptions? The hallmark of Nirmala Sitharaman budget they have been conservative in the revenue assumptions. For the first time, direct tax collection in economy which is slowing down seems to be in mid-teens. Is that achievable or is that optimistic?
Actually, see, it's not even mid-teens. If you add back that 1 lakh crores of tax cuts, then the underlying taxes are expected to grow at 22% year on year. There is a 70% growth assumed in STT. And so there are many underlying drivers. So we can nitpick. See, the point is that the trend has been very different from what we were used to. Between 2001 and 2019, the personal income tax as a percentage of GDP was rising at about 5 basis points a year. Since then, it has been rising at about 20 basis points a year, and the growth this year has been quite spectacular. So one can nitpick and say that maybe there is, given that capital gains taxes will be slower, that there's been a slowdown in market volumes, and therefore the STT volumes may not grow. So they have been growing at a very rapid pace over the past 3 years, but that they may slow down a bit. So maybe there is a 30,000-40,000 crore slippage that could emerge there. But given that the nominal GDP growth of 10.1%, very reasonable assumptions on GST, on customs, etc., it suggests to me that at least the numbers. If the global economy goes into a recession because of the start of the trade war, then of course all bets are off. But on a steady state basis, I think there is enough slack and there is enough conservativeness in the budget estimates.
The talking point is that has the government pivoted? Like in 2001, they pivoted towards capex. I distinctly remember, and I'm expanding this question for the benefit of our viewers. Government came out and said that we will start building India. Now, have they pivoted from build India to consume India?
I don't think so. The state governments definitely have. The state governments are, I think, responding to the rising inequality by one after another announcing income transfer schemes. And, maybe when the Bihar budget is announced in anticipation of the elections later this year, you may see that again. Maybe UP will announce it next year. But for the central government, the way to interpret the shift that has happened is that comparing FY19 to FY26, everything on a percentage of GDP basis, you realize that most the trends, and the important thing is that FY26, the primary deficit, which is fiscal deficit minus the interest cost, is about 0.8% of GDP. It was 0.4% of GDP in FY19. So the COVID impact on the run rate of fiscal deficit is actually almost now eroded. So therefore, it makes sense to compare FY19 and 26. There are minor tweaks here and there, but the big change is that your personal income tax as percentage of GDP has gone up, and the capex as a percentage of GDP has gone up. So there was this transfer happening. So as the tax compliance improved, it was being invested in capex. Now, that model is likely running out because the government is running out of areas to spend on. And this is something that most people don't seem to appreciate, that under the constitutional separation of powers, the central government can only do national highways, railways, telecom, defense, major ports, and airports. So these are the 6 major areas where the government can spend. The rest, it has to work with the state governments through central sponsored schemes. If you just start transferring without any conditions, the risk is that the money could get wasted. We saw that in FY25. So we saw that out of the 11.1 trillion rupees, 11.1 lakh crores, only 9 lakh crores was what the government could potentially directly control. 2.1 lakh crores was included 1.5 lakh crores of interest-free loan to states for capex, and about 64,000 crores was stuff that the government, I think, was trying to keep aside in case there was additional demand later in the year. So there is a problem of scope. How much more can you spend? Maybe there is some more scope to spend on railways. Now, if this is the model and you do not want to consolidate faster, you shouldn't be consolidating faster because then the economy slows down and the lower equilibrium and debt to GDP starts to get hit. And therefore, you still need to spend this money. And I think the decision to give a tax cut was perhaps that if all the additional taxes are coming from this segment, just give some back so that at least the overall impact on the economy is not that negative. That's the way I interpret this. Now, the fact that it is concentrated in the maybe 75 lakh people who actually pay taxes and disclose incomes in the 12 to 50 lakh bracket is just an outcome. But I think the underlying design was that there's no scope to spend more on capex. And then how do you keep the spending up without distorting the economy? Might as well give it back to the people who are paying more taxes. I think that's the approach here that has been taken.
Okay. Now let's look at this entire 1 lakh crore which comes back into the system. That's a very smart number. How will that impact the multiplier in the economy? And where will that 1 lakh crore go? Will it be again soap, shampoos or biscuits? Could it be travel tourism? Could it be something different? Or could it pure go in terms of leverage and credit card debt, etc., etc.?
See, that's the most important question. The 12 lakh to 50 lakh bracket, see, 70% of this 1 lakh crores will go into the people reporting incomes between 12 lakh and 50 lakh. Now, that's an our estimate based on FY23 data. There was about 58 lakh people who reported that much to the tax authorities in FY23. Let's assume that number has grown, the economy has grown in nominal terms. So maybe there are 75 lakh people. And these are people who account for the top 10% of the population, right, in terms of incomes. And therefore, the likelihood is that incremental consumption will be more discretionary than staple. So not more biscuits. That's more, the 60th, 70th, 50th percentile, 40th percentile, not 90th percentile. So the likelihood of this being spent on discretionary items, the likelihood that some amount gets saved is also very high, given that most of the financial savings also come from this segment. So this segment is naturally prone to saving more. It is also a segment which is also very financially savvy. And then taking, vehicle loans or real estate loans, and therefore the impact of whatever 80,000 crores post savings that is remaining, that getting a multiplier because these folks can actually take loans to buy a house or a car. Therefore, the impact on demand can be quite meaningful. Now, the bigger questions are: will this lead to a rise in the current account deficit? Will this lead to a push to inflation? I think the answer to that is very clear and no, because at an aggregate level, the government is still bringing down the fiscal deficit. So in a way, whatever extra was coming in through better compliance is being handed over as kind of a reward to the taxpayers who have been supporting this boost in capex. So this gets concentrated in this 75 lakh households and in a few segments, maybe like autos, jewelry, some more, clothing or travel or, stuff like that.
Do You think there needs to be that additional fill-up now, come next week, or rather this week actually, from the central bank? And would we finally see some rate easing coming in?
I think that is, I mean, after the trade wars, the most important question for the markets and the economy. The economy is clearly slowed, and there are three ways that you can manage the cyclical aspects of the economy. The first is, of course, fiscal, where, as we discussed, there's not much room. Going forward, there'll be slightly more room because the pace of consolidation is easing, but this year there was not much room. Then you come to the monetary side. Now, in monetary, there is the cost of money and there is the quantity of money. There is a lot of obsession with the cost of money, whether interest rates fall by 25 basis points or not. In my view, given how inflation has behaved, given how the diffusion aspects of inflation have behaved, in the sense that the number of items with more than 6% inflation has actually gone up in December, and that we may see a sequential decline. We have seen a sequential decline pricing in January, but it's very hard to say that this will stick. And therefore, before inflation becomes sticky, should the RBI be really cutting? So I think it's a toss of a coin. I know the Overton window has shifted, meaning the consensus view, given that everyone expects a rate cut. The costs of cutting rates and distorting markets is therefore reduces a bit. Therefore, it makes the RBI's job easier. Though if one was prescribing, it would not be very wise to be cutting this week. Then we come to the quantity of money. And there, I think there is a lot of scope for action. So there is 5 lakh crores of liquidity, which has been sucked out because of foreign currency interventions. When the RBI sold dollars and bought rupees, they've replenished about 1 lakh crores of that on last Monday. There's been a bit of a CRR cut, but that takes time to sort of flow through the system. I think for the economy to revive from here, we have to find ways of getting credit growth back up from about 11% to say 14, 15%. One shouldn't be trying to target like China a level of credit growth, but it is reasonable to expect that if the credit growth in the economy goes from 17 to 11, the economy obviously slows. So are there ways that the RBI can act, say, by maybe reducing the emphasis on the credit deposit ratios that it imposed on some private banks, by using macroprudential weights, risk weights on certain types of loans, which can be brought down, say, for example, for housing, for mortgages, where the real estate cycle is at a decent place. The risk of home loans going bad is lower right now. So why not try to push some credit through that channel? Now, once that starts to pick up, the liquidity creation starts happening through the bank loans themselves. As banks give loans, they create deposits. So I think the quantity side and credit growth side is where a lot more action is perhaps necessary. And once that comes through, I think the economy will see a bit of a rebound.
I just want to get to the point that you were saying that the RBI shouldn't be easing rates. Why is that? Have we snapped that line? Yeah, seems to have. Yeah, seems to have been the case. By the way, now down over 200 points for the index, while Nykaa, UPL, TVS Motors, Supreme Industries, etc. are holding out in trade. That's not quite the case with the HAL, with the BEL, NCC, Hudco, which is down, cracking 8.5% as we speak right now. And even within the large caps, Nichols, it's the similar names, Maruti, Eicher, Titan, Nestle, etc. But their entire capex theme is continuing to see red ticks.
See, Aisha, I think markets are about what you think would be popular. Right now, capex, which was like the standout theme post 2021 budget, is no longer a popular theme. P multiples were stretched, economy is slowing down, the room of P multiple is not there. While 14-15% growth is not bad, and which is what a double-digit capex is impressive number. It is higher than consumption. Let me put it this way. It is not that government is not going to be spending. But the P multiples were so out of whack. Defense, railways, these stocks had become 80-90 P multiples. And when these stocks become 80-90 P multiples, there becomes a bit of a challenge in terms of how things actually progressively would move. Neelkanth, we've got lots of questions for you. I hope you have that much time. And I'm assuming that, we can throw in some more questions here. ultimately it comes down to what our viewers should do post-budget. And this whole thought that consumption is going to be the driving factor and capex is not going to be a driving factor, you think it's outright silly to assume that? Because like you initially indicated, that consumption cannot grow at 14-15%. Capex will grow at 8 to 10%. So capex aggregate growth is still higher than consumption. Then why are markets so nervous? भाई मिश्रा जी बताइए, तो गड़बड़ हो रही है.
See, the markets will act on a whole range of inputs. I think it's also about positioning, but in the short term. But see, the way I see it is if investment to GDP ratio in the economy is in the early 30s. I mean, we can debate is 32%, 33%, 34%. And the central government capex is 3.4%, or whether of GDP. So it's about 10% of the overall capex. And that also includes, the amount that they're giving to state governments. So to obsess about this change, so fact is that investment to GDP ratio bottomed out at 27% in FY21. It is at 30 to 33% right now. The central government capex has gone up by about 1.5% point or so. So a large part is actually coming from the revival in the real estate sector, the need to spend more on power generation, and because real estate and power generation are doing well, the demand for steel, demand for cement, and all that. And therefore, to take a call on consumption versus investment based on the allocation of 1 lakh crores of government's funds on a tax cut is something that I think may be an excessive reaction. Perhaps what is also happening is that with the trade war on, and actually this has been launched, and once you've launched it, it's going to be very hard to roll back. Without losing face, and so therefore this uncertainty lasts for a while. All growth sensitive stocks then start to take a beating. The reason I would counter that, I mean, that's the market reaction. I think that is also affecting the market today. But the way I would counter that is a large part of the growth that is penciled in for India is domestic, and therefore I think the risks of the global trade war somehow coming and directly impacting India meaningfully, at least economically, is very low. The markets, I think, will get impacted. So this is a long answer to your short question, which is, does this warrant a change in the positioning of overweight financials and industrials and cement and the underweight on say staples? I think that position I would stick to it, and given today's response, I would actually add to that.
Mr. Mishra, this is Shrishti also joining in. I just wanted to touch upon the point you were making, the launch of trade war. How well is India placed to actually go ahead and fight this trade war? Because once again, what we are seeing is that it has started, and maybe the devil in the room, that is inflation, could once again knock our doors. To start with the US, what could be the likely impact on the rupee versus dollar trade? Other than that, in terms of the sectors, where is India likely to get the benefit out of it, and where is the most concern lies? Any sense on there?
So I don't think anyone benefits. See, at least in a conventional war, though while it is very sad and damaging to lives and livelihoods, so long as it is isolated, it actually becomes an economic stimulus in some parts. But when you have something like a trade war, the whole objective is to hurt economically. And if you see the commentary coming from the US as well, I think it is acknowledging that it will hurt us, but we want to solve some non-economic and political and sociological problems through hurting the other party and yourself in the process. So I don't think anyone benefits. I think this is growth negative for the whole world. So point is, there are estimates of 0.8% to 1.5% that I've seen because of the first salvo. But I think that's just the first order effect. Now that Mexico and Canada are also threatening to retaliate, it is reasonable to expect that other countries. I mean, if for the NAFTA allies, the US can do this, and now they're threatening it on Europe, everyone else then starts to think about retaliation, and then it hurts everyone. So, this concept of MAD, M-A-D, mutually assured destruction, I think becomes very important. Now that it has been launched, I think backtracking very quickly looks very difficult. And that means that there is an additional uncertainty. So that's another reason why I think most industrials stocks would be lower, because if no one is clear on where the tariffs are going to be, where end demand is going to be, there is why will anyone do any capex at all? So that uncertainty I think remains. Can India benefit from this? In the first round, definitely not, because what we need is the global economy to do a lot better. We are dependent on external demand to grow at least to deliver part of our GDP growth. Can there be opportunities that emerge in the midst of all this because of Indian companies starting to displace the Mexico or Canada or China? Frankly, if you saw the tariff changes that India made during the budget, where the effective rates on many have not come down because of the rise in cesses, but the headline tariff rates have been brought down. They're all to prepare for what could be the next in line, right? So once he's done with his closer friends and China, then it gets down to maybe Europe, and maybe then comes to India as well. And why would India be spared? So I think all you can say at this stage, given how many moving parts exist, is that the impact on economies and markets will be negative. Now, the channel through which this happens, so if you're adding, say, 25, in a way, you're taking from the US consumer and giving it to the US government, that by itself means that your 10-year bond yields, at least the term premium, if they're serious about it and this lasts, would actually come down. But because prices are going up, the Fed starts to, will may need to raise rates again, and just creates a lot of chaos for positioning, etc., in the financial system. The dollar appreciating also in the near term is very negative for growth in all of emerging markets, because risk capital formation slows down. I can't see anything positive coming out of this.
And which perhaps is a very important question in terms of understanding the uniqueness of India. Whatever we may say, good, bad, ugly, our GDP every time goes above 7.5%, it stays there for 2-3 quarters, comes back to the mean, which is in and around 6. So whichever way I may twist, I may turn, ultimately the bottom line here is that in great years we do 8, in bad years we do 5.5, but the average is between 6 to 6.5. Are we headed there back? All the analysis is all extra analysis, extra time hai wo. Reality is 6 to 6.5% is where we are.
I think there is a lot of merit in that. And as you see people's behaviors, you begin to appreciate why that is the case. So the moment we start getting to 7.5%, 8%, I think then people, you can see that a sense of complacency starts to creep in for all economic participants. Some of our regulators then become quite vigilant, and they start to take steps which then reduce risk taking. And when then growth falls below 6, then the regulatory easing starts. So now you can see that all financial regulators, all economic regulators are now starting to revisit some of the decisions they took, acknowledging that growth has actually slowed too much and that it needs to be revised back up. And therefore, I think assuming, so especially when the chips are down, when it looks like things cannot get any better, it is important to remember that on a 5-year basis, if you took the last 25, 30 years, the growth has been between 6 and 7%. The 5-year CAGR, except for COVID, which was of course unnatural, it has been in the between the 6 to 7% range for most of the last 30 years. It did go up a bit in 2007-8, but then corrected very quickly. So I do think that that's our trend growth. Our structural growth remains the same. A lot of the growth drivers in the Indian economy are local. So I'll go back to our 2025 outlook story, that turbulence globally, but the drivers remain local. So if we can get credit growth back up, if we can take the right measures to get the right quantity of money, the right risk weights for bank loans, I think loan growth can pick up because our real estate cycle is doing better. And we should be able to sustain a 6.5% plus growth rate even in the midst of this global turbulence.
All right, and lastly, Mr. Mishra, there's a huge debate that is going on that the current slowdown that we are in maybe is cyclical in nature and not structural. Why do you think that we are in a cyclical slowdown and this cannot last longer, maybe for the next more than 3 to 4 quarters?
So that, of course, is also an extremely important question. Let's look at how the structural growth is calculated. The structural growth is calculated on the basis of what is the labor input, how are the workers, workforce expanding, how is total factor productivity improving, and total factor productivity is nothing but the impact of technology, of things like digital public infrastructure, piped water, dense energy, access to dense energy, technology infusion. You look at all the global capability centers and the pace at which services exports are expanding, a lot of foreign expertise is coming down to India. So it's reasonable to expect healthy growth in labor growth, which is demographics. There is healthy growth in total factor productivity. Of course, we can accelerate it through more structural reforms, but they will show up maybe 3-4 years later. And then there's capital formation. So if your capital formation, large part of the slowdown was because of real estate and the slowdown in power capex, and those are actually now, there's no need to slow them down further. I think 7% growth rate seems to be a nice structural rate at this stage. And therefore, because all of those factors are not going to change, that is how you do structural growth. Then if the slowdown is happening, then it is cyclical. And then when you do some digging, you realize that because of the money supply growing too slow, base money supply growth of less than 5%, some skew, back-ended fiscal spending in FY25 this year. You may have noticed that in December, the central government capex went up by 95% year on year. So as we enter FY26, you will see a tailwind from late year fiscal spending by the government. Even despite the fact that they brought down the fiscal deficit from 4.9 to 4.8 this year, the capex spending that is implied in the revised estimates is a 21% year-on-year increase in the last 3 months. So that's a very strong cyclical impetus. On top of that, if the RBI does act decisively on provision of the quantity of money that the economy needs and backs off from some of the I would say the moral suasion type tightening that it was doing, then I think the credit growth can revive from here. Credit growth goes back up to 14-15%. We are above 6.5% again. So that's why I think that this is a cyclical slowdown that we're seeing. Though of course it warrants an execution from both fiscal and monetary authorities.
Mishra, with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us. Definitely. It's indeed interesting to have your take and the budget analysis on 2025. But with this, viewers, it's time to slip into a very short break. Don't go anywhere. We'll be right back after this quick break.